Hey Bowtie Nation, Joseph Hogue here with one of the most important themes of the last 2 years and the stocks to watch for it. Nation, retail investors are driving this market. That's those Main Street investors like you and me versus the institutional side of the industry, the portfolio managers and the hedge funds investing their own clients' money. The growth in regular investors has been explosive, with Deloitte estimating more than 10 million new investing accounts opened in 2020 alone. That same survey found the share of off-exchange trading and estimate for stock investing from retail investors grew to 47% of the total U.S. stock trading volume by January of last year. That's a 30% increase from 37% volume just 2 years earlier. So then where the saying used to be follow the smart money or invest in the stocks most followed by those big money managers, we are now in a different era, one where you need to be following the retail investor sentiment and investing with the crowd. In this video, I'll show you how the retail investor is changing the stock market and how that affects your investing strategy. I'll then reveal the 5 top stocks among Main Street investors, along with the 2 stocks they are avoiding. But you know we can't get started here on the channel without that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. I'll be using the public platform to find those top stocks as well as the least popular. The platform is a solid investing app with some great features and no cost investing. You can invest in stocks, ETFs, and crypto. The app lets you buy fractional shares, which means you can invest any amount you want, no matter how much the stock costs, and the platform is going to give you a fraction of the share of that stock. What really drew me to Public, though, is that social aspect. Public is built around these shared portfolios, so you can see what other people are investing in when you're deciding on your stocks. Users show their portfolio of stocks and crypto and share updates through their social feed. It's a fun way to follow your favorite investors and their portfolio. You can even create group chats with friends, family, and other investors. Basically, it's like Facebook and E-Trade had a baby. Another feature I really like here is this investing themes, collections of stocks around popular themes like the metaverse, electric vehicles, and stay-at-home stocks. For example, if I click through to this metaverse collections, I can see a list of stocks in that theme like Bilibili, Sea, and Block that might give me exposure to that growth. For this video, I'll be using the Stock Trends tab, a page ranking the most popular stocks held by investors on the app. I want to get started on that list of top stocks, so I'll show you how to analyze these and how those retail investors are changing the market later in the video. I'll be counting down the top 5, then reveal those 2 least popular and the one I actually like as a contrarian investor. The 5th most popular stock on Public, AMC Entertainment, ticker AMC. Obviously, this is one of the big meme stocks that really took off with retail investors last year, investing in the rebound, the anti-lockdown stocks. So when the pandemic lifted, people getting back into the theaters and going to watch those movies. And we can look here on the statistics page for the stock on Yahoo Finance and check out some of these. And I was really actually surprised when I saw this price to sales ratio. Price to sales of only 6.9 times, 7 times sales. You would expect higher from one of these meme stocks, these growth stocks, 6.99 times sales. And if you look down here to the revenue growth, over 500% revenue growth on a year-over-year basis for the most recent quarter. So as the blockbusters are coming out, as people are getting back into the theaters, AMC Entertainment is actually growing into this revenue, something you can't say for some of these other meme stocks that are still struggling with revenue growth. If we go to the analysis page here for AMC, we see that it is still expected to post negative net income over the next 2 years, a negative 2.75 per share this year, negative 75 cents a share in the next year for income, getting closer to that profitability, but still negative earnings. But if we look at the average analyst estimates for revenue, $2.5 billion in revenue expected this year, 98% over the last year, and then $4.6 billion next year. That would be another 87% on top of that. So definitely growing back those sales, getting back into a normalized sales environment, and possibly in 2023, getting back into profitability. If you look at the ratings and the price targets from analysts on Public, though, the analysts just don't think so. Analysts on a scale of 1 to 5, with 1 being a buy and 5 being a sell, have AMC at a 4.2, so about as close to a sell as you get with stocks. Well, the price target of $10.45 a share is about a third of the current price, so analysts just aren't bought into the stock as much as retail investors. If you scroll down on any stock page on Public, you're going to see the updated news, analyst price targets, and the earnings for the stock. Keeping with that platform's social feel, scroll down and you can also see what investors are saying about the stock. So it's a great way to get a feel for sentiment and what others are watching. The fourth most popular stock on Public, the Walt Disney Company, ticker DIS. Obviously, that traditional theme park and entertainment company now transforming itself into more of a studio and streaming entertainment. And we can see here some of these statistics, a price to sales ratio of 4.14 on a trailing 12 months. So quite a bit less expensive than AMC Entertainment, but maybe a little more expensive than a lot of the other entertainment and media companies. So obviously Walt investors are paying more for Walt Disney Company on that success in streaming. And if we look down here at the quarterly revenue growth, 26% on a year-over-year basis in the most recent quarter. Obviously, from a lot of that studios and streaming business coming back, the theme parks not quite there yet in terms of rebounding after the pandemic, but we're starting to see a little bit more revenue growth from the theme parks as well. And if you look here at the estimates by analysts, you see an estimate for $73.6 billion in sales this year, 2022, which would be a 24% increase. Next year, they have pegged at $82.6 billion, which would be 12%. So obviously slowing down that sales growth as the streaming slows down, as the return to theme parks revenue slows down, but still a solid revenue growth for a company as old as Disney. And analysts are much more positive on shares of Disney, with a buy rating of 1.6 and a target of $193. That's well over the current $150 share price. We've still got 3 more top stocks to highlight, but I wanted to share how the retail investor phenomenon is changing the market, and more importantly, how it might affect your portfolio. We've got some great data from recent surveys of new investors and how they invest. First, it's a much younger demographic. A survey by Charles Schwab found the median age of investors starting in 2020 was just 35 years old. Now that's more than a decade younger than the 48-year-old median for investors starting before the pandemic. Retail investors also tend to be more bullish, more optimistic than those institutional investors. And whereas hedge funds and money managers might put bets on a short side, retail investors are almost totally on the long side, as long investors buying stocks that they like. With Main Street investors now firmly in control, that's supportive of stock prices and upward momentum. Retail investors are also more socially guided in their investments. Now, this new group of investors grew up in that era of social media, and they're comfortable getting stock advice from their network rather than the analysts and the experts you see on TV. And that means you need to be tuned into the social sentiment around a stock. The third most popular stock on Public, shares of Apple, ticker AAPL, that Cupertino giant that makes pretty much everything, maybe even your car someday. And Apple is trading like a growth stock at 32 times on a price to earnings basis and 8 times price to sales. Looking at this revenue growth, though, it is growing like a growth stock, 28 times, obviously from a great iPhone cycle, but how long does that cycle last? You know, something that you really need to understand for Yahoo is it's very cyclical around that iPhone cycle and around the revenue growth from that cycle. And analysts aren't quite sure that that growth can continue, with just 4.4% sales growth expected this year to $381 billion. Looking out further to next year, 2023, analysts expect the company to book just $401 billion in sales and a 5% sales growth. And that's reflected in the ratings on Public. Analysts do have a buy rating with 1.6 on shares of Apple, but a target price of $174 a share, very close to the current price of $172. The second most popular stock on the Public platform, electric vehicle maker Tesla Inc., ticker TSLA. And if we look at the valuations here on Tesla, 330 times on that trailing PE basis and 24 times on a price to sales. Now, as of yet, it has booked that quarterly revenue growth 56% on a year-over-year basis. So it is living up to that growth stock status, but how much longer can it do that? If you ask analysts, at least for another few years. The average estimate for revenue is $52.25 billion this year, growth of 65% over the last year. Looking out further, $74 billion next year for 42% growth, so definitely growing into those valuations. But Tesla is another one where the shares have just gone too far, too fast for analysts. Analysts have an average rating of 2.7, which would be about an average hold, and a price target of just $860 per share, under the current $1,000 per share. Now, just scrolling through these top stocks investors are buying, I don't want you to think you should buy these blindly. You still need to do that analysis and understand how they fit with your portfolio. And most of the stocks we're seeing in this list are those ginormous mega cap stocks, the $100 billion companies, so it's going to be kind of a cross between growth and value. They don't quite have the growth of those smaller penny stock upstarts, but they also might not have the discount of the best value stocks. So one way I like to look at these then is to adjust the price to earnings ratio by the company's growth rate in earnings. And for example, Disney is trading at a price of 38.9 times its earnings, which is actually really high, but it's also growing those earnings by about 31% annually. So if we take that PE ratio, the 38.9 times, divided by earnings growth of 31, then we get a 1.25 on the price to earnings to growth measure. Now that's still pretty expensive. I like to see this growth stocks at a PEG of 1 or less usually, but we'd have to compare that against other stocks. Now all you out there in the nation know I'm usually a big believer in checking the balance sheet of a company and looking at how much cash and debt it holds as a sign of financial stability. And for most of these companies though, with the exception of AMC, it's not really going to be an issue. These are multi-hundred billion dollar companies, some even into the trillions, so they're not going to face that same cash flow problems or financing issues you get with smaller companies. Instead, I'll usually place a greater emphasis here on the return on equity, or the ROE measure. Now that's the net income or earnings of the company divided by shareholders' equity. So it's much more like a profit of the company is generating compared to the equity invested by shareholders. Using Disney as an example again, we see on the balance sheet that the investors have equity of $88.5 billion. That's the value of the company's assets minus the debt it owes. Then from the income statement, the company made net income of $2 billion over the last year. So that's profit divided by equity is 2.25%. Now again here, we really can't say if 2.2% return on equity is high or low until we compare it to similar companies, but it's saying something that management is only able to generate about 2% return on shareholder investment. And the number one most popular stock on public, shares of Amazon, ticker AMZN. Now, shares of Amazon have always been too expensive for a value investor like me, but after those shares of Tesla, the valuations here don't seem so ridiculous. Trailing PE ratio of 67 times and a price to sales of just 3.8. That was actually lower than Apple. You see the growth has slowed down here, just 15% over the last year. And here we see analysts actually expect that sales growth to pick up to $470 billion this year, growth of 22% over the last year, and then 17.7% growth in the next year. And Amazon does have one of the best ratings and price target upsides of all 5 stocks on our list, with a buy rating of 1.2 and a price target of over $4,000 a share, more than 20% above the current stock price. But now if we look at the rest of the top 10 stocks held on the platform, we see a mix of those mega cap companies like Alphabet, Microsoft, and Facebook. But we also see some of these smaller upstart companies like Shopify and Coinbase. So it's really interesting that investors aren't just going for those biggest companies. Now I want to reveal the least favorite stocks here, and it brings up an important investing strategy, playing the contrarian. Now that's when you look at what the crowd is doing and say, nope, I don't think so. I think the crowd is wrong on this one and I'm going to invest differently. And now you can go either way on this. Maybe you buy a stock that investors just don't seem to like right now, or you avoid some of the most popular stocks on the idea they might be overvalued. But it is important to point out though, you're not doing this just to be a pain in the ass. You still have to research the stock, but you're using your own judgment rather than just following the crowd. And here, if we look at the least popular stocks on the public platform, we see the First Trust Clean Energy ETF, ticker QCLN, and HubSpot, ticker HUBS. Now, I want to point out these aren't necessarily the least popular stocks across the entire market, just the least widely held of the 500 ranked on public. So we still have some investor interest, just not nearly as much of those top stocks. And I actually do like this Clean Energy ETF, which is a fund holding shares of 60 companies within that clean energy and renewables theme. And within those companies, you get a good mix of industries in this theme, like auto, semiconductor, renewable energy. So it is a solid one-stop fund for diversification and exposure to the growth in that green revolution. Click on the video to the right for my favorite dividend stocks in each sector, the top paying stocks in each of the 11 stock sectors. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.